Silver has suddenly become the metal that investors cannot afford to ignore. The question is no longer simply whether silver is going higher. The more important question is whether this move is just another short-term rally, or whether the market is beginning to enter a completely different phase. And there is one signal that I think deserves much more attention than the headline price. Physical silver demand appears to be behaving differently from gold. In the source material we are analyzing, a coin dealer describes silver moving from roughly the $54 to $55 area to above $66 in less than a month, a gain of more than 15%. At the same time, the dealer says gold was coming into the shop much faster than it was being sold, while silver was still requiring additional wholesale orders to meet customer demand. Now let me make something very clear. One dealer's experience is not the same thing as official national demand data. But as an analyst, I don't ignore these observations either. Why? Because physical market behavior can sometimes reveal a change in sentiment before the broader narrative catches up. When silver was trading around $54.55, according to this dealer, buyers were hesitant. People were worried that the price could fall further. But after the market recovered, confidence returned, and customers started buying again. That is classic market psychology. Fear creates hesitation, then price momentum returns. And suddenly, the same investors who were afraid to buy at lower prices become more interested after the metal has already moved higher. But here's where I want to take the analysis one step further. The real story may not be the price, it may be the gold-silver relationship. The dealer places the ratio around 67 ounces of silver for 1 ounce of gold and uses 60-to-1 as a personal threshold for when gold becomes relatively more attractive. Above 60, he currently prefers silver. I would not treat 60-to-1 as some magical market law. It isn't. The gold-silver ratio moves for many reasons, including monetary expectations, industrial demand, investment flows, and liquidity. But it is extremely useful as a relative strength indicator. And right now, that indicator tells us something important. Silver is gaining ground against gold. That means the market may be moving away from a purely defensive precious metals trade and toward a more aggressive bullion cycle. Gold is traditionally the cleaner monetary hedge. Silver is different. Silver has monetary characteristics, but it also has industrial demand. That means silver can benefit from two separate narratives at the same time. If investors want protection against monetary uncertainty, silver can participate. If industrial demand remains strong, silver can participate again. And when both forces move in the same direction, silver can outperform gold dramatically. That is exactly why the current rally deserves attention. But I would also issue a warning. A fast move from the mid-50s into the mid-60s means investors should not confuse momentum with certainty. Silver is historically more volatile than gold. A metal can have a powerful bullish structure and still experience brutal corrections. So my thesis is not that silver can only go higher. My thesis is much more interesting. The market may be transitioning from a fear-driven gold story toward a broader precious metals cycle in which silver starts taking the leadership role. And if that transition continues, the next question becomes much bigger than $66. It becomes what happens when large investors start chasing the silver move instead of simply watching it. The silver demand signal nobody should ignore. There is another part of the story that I think is even more important than the price itself. What buyers are doing after the price has already moved higher. Normally, when a commodity rises quickly, you would expect some buyers to step back. But the dealer observations in this source suggest something different is happening in the physical silver market. The dealer says silver inventory is still being replenished from wholesalers because demand remains strong, while gold is moving in the opposite direction, with much more gold coming into the shop from the public than going out to customers. Now, again, this is one dealer's experience. It cannot be treated as proof of the entire global market. But it gives us an important question. Why are buyers becoming more comfortable with silver after such a large move? Part of the answer may be momentum. When silver was around $54 or $55 according to the dealer, buyers were nervous about another decline. Once the market started producing consecutive positive sessions, confidence returned. The dealer specifically describes customers becoming more willing to buy again as the price moved higher. This is one of the strange realities of markets. People often say they want to buy when prices are low, but psychologically they usually want confirmation first. They want to see the market stabilize. They want to see the trend change. And once that confirmation arrives, they become willing to pay a higher price. That can create a feedback loop. Higher prices improve sentiment, better sentiment increases demand, stronger demand supports prices, and rising prices attract even more attention. But there is another reason silver deserves attention right now: the gold-silver ratio. The source places the ratio around 67-to-1. Recent market analysis has also documented substantial compression in the ratio during 2026, reinforcing the idea that silver has been gaining relative strength against gold. For me, the ratio is not a buy or sell signal by itself. It is a way of asking a much more useful question: which metal is currently attracting the stronger marginal demand? And right now, silver has a compelling argument. Gold has already established itself as the dominant monetary hedge. Central banks, institutions, and investors understand its role. Silver is different. It is smaller, it is more volatile, and its demand comes from both investment and industrial uses. That combination can make silver extremely powerful during a broad precious metals cycle, but it can also make silver dangerous from a volatility perspective. If economic expectations deteriorate sharply, silver's industrial side can become a headwind even while its monetary characteristics remain supportive. So I don't want to make the mistake of saying silver is rising, therefore silver must continue rising. That is not analysis. The real signal is the combination of price momentum, relative strength against gold, and physical market behavior, and there is one more development investors should watch. The dealer believes premiums on physical silver could rise if larger investors return and readily available investment-grade silver becomes tighter. That is an observation, not a confirmed market-wide shortage. But if something similar begins appearing across multiple dealers, exchanges, and investment products, the story becomes much more significant. Because then we're no longer talking about retail enthusiasm alone, we're talking about a potential shift in market structure. And that is where this silver rally could become much bigger than a simple bounce from $55. The real question now is whether the next wave of demand comes from ordinary physical buyers or from larger pools of capital that have been watching silver from the sidelines. If that second group starts moving in, the current rally could look very different in hindsight. Why silver could be entering a different phase. The most important thing about this silver rally is not simply that the price has moved from the mid-50s to above $66. The bigger question is whether the market has experienced a change in psychology. And I think the evidence in this source gives us an interesting clue. When silver was near $54 or $55, buyers were reportedly hesitant. They were worried that the market could fall further. But after the metal started producing repeated gains, that fear began to disappear. The dealer describes customers becoming more confident and returning to silver as the price moved higher. That is important because commodities don't move purely on fundamentals. They move on expectations. If investors believe the bottom is still ahead, they wait. If they believe the bottom has already passed, they start chasing the trend. And that difference can create a dramatic change in demand. But here is where I want to challenge the simple bullish narrative. A market going up does not automatically mean the market is fundamentally stronger. Sometimes prices rise because positioning changes, sometimes because short sellers cover, sometimes because investors rotate from one asset into another, and sometimes because physical supply becomes harder to obtain at the exact moment investment demand increases. We need to distinguish between those possibilities. The source gives us one potentially important observation. Silver dealers are reportedly still having to order additional silver from wholesalers to satisfy demand, while gold is reportedly accumulating in inventory because more gold is coming into the shop from sellers than leaving through retail purchases. If that behavior were happening across a broad network of dealers, it would be a meaningful signal. But one dealer cannot establish that by itself. So as analysts, we should treat it as a signal to investigate, not a conclusion to celebrate. And this is where silver becomes fascinating. Gold and silver can rise together, but they do not always rise for the same reasons. Gold is primarily monetary. Silver is partly monetary and partly industrial. That means silver has more potential fuel, but also more potential volatility. Imagine a situation where investors become increasingly concerned about inflation, currency purchasing power, or monetary policy. Gold can benefit. Now add strong industrial demand and investors rotating toward a cheaper precious metal. Silver can benefit from both sides. That is the bullish case. But there is a bearish scenario as well. If the global economy suddenly deteriorates, industrial demand could weaken. In that environment, silver could initially underperform gold, even if investors still want precious metals. This is why I would not describe silver as simply the cheaper version of gold. It isn't. Silver has its own market structure. And the gold-silver ratio helps us understand that difference. At around 67-1, the ratio is telling us that silver has already gained significant ground relative to gold. The dealer in our source personally considers levels below 60-1 a point where gold becomes more attractive relative to silver. I wouldn't use 60 as a magic number, but I would watch the direction. If the ratio continues falling, it means silver is outperforming gold. If the ratio reverses sharply higher, it would suggest that investors are becoming more defensive and favoring gold. That makes the ratio one of the most useful indicators for this entire story, because eventually the market will have to answer one question. Is silver merely catching up with gold, or is silver beginning to lead the precious metals cycle? Right now, the price action and the physical market observations suggest that possibility deserves serious attention. And if larger investors begin entering after watching this rally from the sidelines, the next phase could be very different from the first, because retail demand can move sentiment. But institutional and large-scale investment flows can move the entire market. That is the risk and the opportunity investors need to watch next. The silver supply question could become the bigger story. There is another part of this silver rally that investors should not overlook. What happens if demand keeps accelerating while readily available? Physical silver becomes harder to source. The source we're analyzing gives us an interesting dealer-level observation. The dealer says silver continues to require wholesale replenishment to meet customer demand, while gold has been moving in the opposite direction. With substantial amounts of gold coming into the shop from the public, that doesn't prove there is a global silver shortage, and I want to be very clear about that. One dealer's inventory experience cannot establish the condition of the entire silver market, but it does raise a question that deserves attention. What happens if the current physical demand trend becomes much broader? Because silver is a relatively small market compared with gold. The source's dealer makes an even stronger argument. If large investors begin putting even a small fraction of their wealth into silver, the effect on the physical market could be significant. Again, that's a projection, not an established fact. But think about the mechanics. A retail buyer purchasing a few ounces is one thing. Thousands of investors buying simultaneously is another. And large institutional capital entering the market is something else entirely. When that happens, the market doesn't necessarily respond only through the spot price. You can also see changes in premiums, availability, and delivery times. That's why I am watching the physical market alongside the futures market. If silver prices rise while physical availability remains comfortable, that is one kind of market. If silver prices rise while physical buyers are increasingly competing for limited investment-grade products, that's a very different market. And this is where the gold-silver ratio becomes useful again. The source places the ratio around 67-1 and argues that silver remains more attractive at levels above 60-1 from the dealer's personal perspective. But here's my warning to silver bulls. Don't turn the ratio into a guarantee. A falling ratio means silver is outperforming gold. It does not mean silver cannot fall. And after a move of more than 15% in roughly 30 days, according to the source, investors need to respect the possibility of consolidation or a sharp correction. This is especially important because silver has historically been a much more volatile asset than gold. You can be right about the long-term trend and still be wrong about the next few weeks. That's why I don't want viewers to chase a vertical move simply because everyone suddenly becomes bullish. The better question is whether the underlying demand continues after the excitement disappears. If silver pulls back and physical demand remains strong, that would actually make the bullish thesis more interesting. If prices continue higher but physical demand weakens, then we need to question whether momentum is becoming disconnected from fundamentals. And there is another signal I would watch closely. The source says the dealer believes silver premiums could rise if larger investors return and readily available investment-grade silver becomes tighter. If we eventually see that happening across a much wider portion of the market, then the silver story becomes much more serious, because at that point, we're no longer talking simply about a metal that has risen from $55 to $66. We're talking about capital chasing a relatively small physical market. And if that happens while gold remains strong, the precious metals market could enter a phase where silver doesn't just follow gold. Silver could start leading it. Silver's next move could be bigger than the last. So, where does all of this leave us? In my view, the most important signal in this entire story is not simply that silver has moved above $66. It is the combination of price momentum, changing investor psychology, stronger reported physical demand, and silver's improving performance relative to gold. The source describes silver rising more than 15% in roughly 30 days from the 54,55 area, while the dealer reports that customers are again buying silver and that the shop continues to replenish silver through its wholesaler. That is interesting because the market psychology appears to have changed. At $54 or $55, buyers were worried about another decline. After the recovery, confidence returned. And that creates one of the most powerful forces in markets, fear of missing the next move. But this is where I want to remain disciplined. I don't believe the correct conclusion is that silver can only go higher from here. After a move of this magnitude, volatility is likely to remain high. A correction would not automatically destroy the bullish thesis. In fact, if silver pulls back while physical demand remains strong, that could tell us more about the underlying market than another straight line rally. The next major signal, therefore, is what buyers do during weakness. If investors continue accumulating silver after corrections, that suggests the market is developing deeper support. If buyers disappear as soon as momentum slows, then the rally may have been driven primarily by short-term enthusiasm. That's the distinction I will be watching. The gold-silver ratio is another important piece of the puzzle. The source puts the ratio around 67 to 1 and uses 60 to 1 as a personal threshold for when gold becomes more attractive relative to silver. I wouldn't treat that 60 level as a prediction, but if the ratio continues falling, it would confirm that silver is maintaining its relative strength. And if larger investors eventually begin allocating capital towards silver, the physical market could become much more sensitive to additional demand. The source specifically raises the possibility that stronger investment demand could push premiums higher and reduce readily available investment-grade supply. That is the scenario I find most interesting, because silver does not need to become the new gold. It only needs a relatively small shift in global investment allocation to create a meaningful impact on a comparatively small market. And that's why I think the next phase deserves more attention than the previous one. The first phase was about recovery. The second phase could be about confirmation. Does silver hold the higher levels? Does physical demand remain strong? Does the gold-silver ratio continue compressing? Do premiums begin rising? And most importantly, do larger investors start participating? If the answer to several of those questions becomes yes, then this could be much more than a temporary silver rally. But if the market fails to confirm those signals, we should be prepared for a significant correction. That is the responsible way to look at this market. Bullish doesn't mean blind. My base case is that silver has entered a much more important phase, but I would rather see the market prove that strength through consolidation and continued demand than simply chase another vertical move. Because the biggest opportunity may not be the move we've already witnessed. It may be the move that comes if the physical market, investment demand, and relative strength all continue pointing in the same direction. So keep watching the $60 area on the gold-silver ratio, watch physical premiums, watch dealer inventories, and watch whether investors buy the next meaningful dip. If those signals remain bullish, silver could have considerably more room to run. And if larger capital finally enters the market, the question may no longer be whether silver can reach another major milestone. The question could become, how much silver is actually available when everyone wants it at the same time? As always, this is independent macro and precious metals analysis, not financial advice. Do your own research before making any investment decision.